Coming up this evening, business growth in the U.S. is slowing down thanks in part to the Omicron variant and people calling in sick. We talked to a manufacturer to see how they're managing. And bike maker Peloton suffering another apparent PR crisis. What happened and why is one investor calling on the company to fire its CEO? And Amazon reportedly facing a worker crisis with white-collar workers resigning in droves. What are the reasons? That and much more coming up on NTD Business. Good evening. Great to have you with us. I'm Paul Graney. It's a crazy day on Wall Street today. The Dow Jones was down a massive 1,100 points before rallying this afternoon and ending up in positive territory. The other major indexes were the same. One commentator says they haven't seen anything like it since 2008, around the end of the last major economic boom. The jury's still out on what's behind today's seesaw. Much of the volatility in the market over the past week or two has been credited to the Federal Reserve's plan to tighten monetary policy to fight inflation. Experts say the Fed's loose monetary policy over the past 2 years has been really good for stocks, but they may now be in bubble territory. Now experts are afraid that bubble will pop as monetary policy is tightened. But why the sudden rally this afternoon? That's still very unclear. The Dow rose 99 points, nearly 0.3%. S&P 500 gained 12 points, also about 0.3%. The Nasdaq today gained 86 points, about 0.6%. Who would have thought at lunchtime? And U.S. business activity grew, but at its slowest pace in 18 months in January. Since the Omicron wave dented demand and worsened the supply chain crunch. More on that in a moment. IHS market data covers manufacturing and services. The slowdown was broad-based, with service sector growth hitting an 18-month low, manufacturing hitting its lowest level in 15 months. IHS Markit blamed soaring virus cases for putting the brakes on business activity, with new pandemic restrictions on businesses worsening supply chain disruptions and staff shortages. Okay, so we're joined by our manufacturing maestro, Nicole Wolter. Nicole, great to see you. Thanks for coming on.
Yeah, thanks for having me on again.
Wolter is the president and CEO of HR Manufacturing, also sits on the board of the National Association of Manufacturers. And Nicole, like I said, great to see you. You guys are busy, but I see from the report, and speaking a little offline, we still have inflation, we still have labor shortages. We talk a little bit about COVID. We also have raw material shortages, I'm sure, as well, looking at the new report. How long, has this gone on longer than you expected? And what does it mean for consumers, American consumers?
Well, it has gone on longer than I did expect it to. A lot of my colleagues were thinking that maybe there'd be a little bit of a resurgence with COVID cases right after the holidays, and that is definitely added to the case. I'm on a skeletal crew. We are working different shifts. We're working weekends. It's been really difficult to kind of manage. And then in terms of the consumer, it's really hard for them as well, because I was just grocery shopping yesterday and there was nothing in the stores. And I understand that, because a lot of the products that we produce go into these big OEMs that produce the food process packaging and that kind of equipment. And so when we're stalling, they're having a really hard time trying to get food out into the stores. And then, of course, when it comes to shortage on labor in terms of freight, there's a lot of truckers that we don't have. And, some stuff that used to come in daily, now we're seeing 3, 4, 5, even a week out. So that's really starting to hurt, as well as the consumers with surcharges that I'm seeing on my end that always I have to float on to my customer, which ends up going to the consumer.
Right. I think that more so than ever, we realize that the economy is a complicated web, right? And it's a complicated machine. Do you feel that this gets worse, even worse, before it gets better?
I think so. I mean, there's a saying that's going around now that is, the red is the new black. And I think that's pretty scary. You look at the market today, everything is starting to tank. We still have the chip shortages, which is hurting the car manufacturers. I'm part of that whole issue as well. Surcharges, like I was saying, with plating. I just got a letter today stating that China, who is responsible for 95% of yellow phosphorus, which actually coats a lot of our products that go into these big machines that do all the food and packaging. They're going to limit their output to 10%. So now we have surcharges that are going up 18, 25, 38% with no end in sight. And so we think it's going to get worse before it gets better. And I think it's about time that we kind of look internally to see what we can do to try to mitigate these risks, because it is really hard, not just from a manufacturer standpoint, but also for the consumer, because at the end of the day, it's coming out of their pockets.
How many calls a week are you getting with people saying they have COVID?
Oh, daily. I just got one yesterday at about 1:30 at night. So it's just, I feel like I'm playing a lot of different games, whether it's the futures market when it comes to materials, whether it's trying to figure out who I can move where. Actually, I was just out running a machine not that long ago to try to get product out. So it's all hands on deck. It's all what we can do as a business owner and try to get the product out and kind of help with the economy moving.
It's an interesting time to have the Federal Reserve meeting, right? I think a lot of people are putting this sell-off in the stock market over the past week or two down to the prospects of tighter monetary policy. How do you think it's going to affect somebody like yourself, a manufacturer, the quote-unquote real economy?
Well, I think we're going to start tighten spending. I think that's going to be the new norm. When you see the sell-off, everyone's trying to speculate what's going to happen. Are they going to keep raising the rates? Is it going to be 3 times, 4 times, 2 times? There's just a lot happening. And so for me, I'm looking internally and I'm looking at the books. And I'm trying to see where we can kind of slim down the spending. And for me, that's kind of scary, because that means you're going to not hire. You're going to not really want to order new equipment. You're not going to really want to engage in the new technology that's out there. And of course, if I'm doing that, that means that the bigger companies are going to do the same, but on a larger scale.
Do you feel that this may help the economy in the medium term if we see a little bit less spending, if everyone tightens their belt a little bit, maybe all of this chaotic inflation and these problems that you're seeing trying to get all your product out might be resolved? Or do you think that we could possibly face a recession if it goes too far?
I think we're kind of on that scale where it could go either way, but I do believe we do need to have some sort of reset. Not extravagant, but something. Inflation is going through the roof. There's so many surcharges, but I think until we can get the labor market kind of pulled in and get everybody back to work, it's going to be kind of difficult, because if you start raising rates and we don't really have that workforce to kind of keep generating things and keep our shelves full of product, you're going to really see some scary stuff out there.
It's really incredible times. Nicole Wolter, HR Manufacturing. Appreciate it. Thank you.
Thank you so much.
For all you crypto followers, Bitcoin falling to its lowest levels since last summer before staging its own dramatic recovery today along with stocks. Still, it's about 40% below its all-time high. NTD's Phil Zoe reports.
Bitcoin falling below $33,000 this morning before bouncing back slightly, according to Coinmetrics, and Ethereum dropped below $2,200.
So we don't know why the Bitcoin market has gone down. It'll be something happening internally.
This is causing a lot of panic in all the markets.
I spoke to the author of crypto books Libra Shrugged, An Attack of the 50-Foot Blockchain, David Gerard. He says crypto is an asset bubble that could pop at any time.
That means it's irrational exuberance. People buy in because they want other people to buy in. They think other people will definitely buy from them, and that can't last forever.
And it's not just Bitcoin. CEO of the Divi project, Nick Zapanero, says many of the altcoins, big or small, have also gone down.
Of course, all altcoins are heavily oversold and taking a complete beating, but they just track Bitcoin. Bitcoin tracks the S&P, like I said. So we're just kind of waiting for these correlations to settle themselves out.
Zapanero says it may take a while before Bitcoin recovers.
We should see a bounce at some point, but don't expect it to bounce all the way back to 60K right away. I think we could see it go down into the high 20s before we actually see it turn around.
Make sure you've actually cashed out at least what you put in so that everything from there on is profit.
Phil Zoe, NTD News.
Looks like it's not a good day for Peloton's marketing department. The interactive exercise bike company suffered a bit of a jolt last month when Mr. Big died while using the gear in the premiere of the Sex and the City continuation, and just like that, now it's happened again. And beware, this is a spoiler alert for fans of the Showtime series Billions. One of the show's main characters suffers a heart attack while riding the bike in the season 6 premiere. At least Mike Wagner didn't die. There's still a problem for a company also suffering major real-world problems. Peloton stock is down 80% from its peak, with investment firm Blackwell's Capital, which owns 5% of the company, issuing an open letter Monday calling for the board of directors to fire CEO John Foley. Letter lays out 10 points slamming Foley's performance. Among his key grievances are bad pricing strategy and a poor handling of a recall. And Kohl's has confirmed that it's been approached about a possible sale, sending shares up 36% today. Confirmation follows media reports that a private equity firm approached Kohl's about a potential deal. Days earlier, a group backed by activist hedge fund Starboard Value LP reportedly bid $64 per share, about $9 billion. In recent months, several activist investors have made their pitches to Kohl's board members to change company strategy. The pandemic and online sales have created challenges for the retail industry, forcing famous brands like Sears and Neiman Marcus into bankruptcy. Kohl said its board is reviewing the offers. And Amazon is reportedly suffering a huge brain drain these days, especially of white-collar workers. Some people say that employee attrition, that so many people leave and enter the company inside Amazon, is reaching crisis levels. So what are the reasons behind it? NTD's Con Fredrickson takes a look.
Amazon is reportedly facing a worker crisis, with burnt-out employees embracing the Great Resignation.
Clearly, there's a cloud of just burnout over all of employees right now.
According to Business Insider, at least 50 vice presidents left the company last year. That's a turnover rate of over 10%. Amazon's unusual pay structure is one main reason for the high rate of departures. It caps salaries at around $160,000 for most workers. This is relatively lower than other tech companies. According to compensation data from Levels.fyi, Amazon pays about 15% lower than its peers, and the stock rewards are heavily backloaded. This means employees must wait longer to convert their equity into cash. Now the stock price is down 23% from last July. Many employees, especially engineers and managers, can earn a lot more somewhere else. Founder and CEO of Village, Debbie Yadagari, says another reason is the lack of culture from top to bottom.
When you have a large organization such as Amazon, it's very hard to create a culture where you have policy up here and have it trickle down through every level of management.
Yadagari suggests that they need to rethink the tools they have in place to create a better culture of support for all employees.
The way they can do this is by mandating certain manager training that becomes automated. So that way every manager is receiving the same message throughout the organization.
According to Levels.fyi, Amazon is adjusting compensation for some of its most valued employees. Colin Fredrickson, NTD News.
And several European airlines and airports are calling for changes to the European Union's proposed climate laws. They just formed an alliance of nearly 20 members, including Lufthansa, Air France, and some major airports too. The EU's proposal for the aviation industry includes stricter emissions rules, the use of synthetic fuels, and a tax on kerosene used in jet fuel. Now, the industry group argues business will go to non-European airports, which won't face the same rules. The alliance rejects the kerosene tax outright. The group did say they don't oppose the EU's Fit for 55 climate package. That plan aims to cut greenhouse gas emissions by 55% by 2030. Air travel accounts for around 3% of global emissions. And China's Evergrande today says it's seeking more time from its offshore bondholders. Comes as the Chinese real estate giant is working on what it calls a comprehensive and, quote, effective debt restructuring plan. Shares in Evergrande Group rose early on Monday after it named 2 new board members. The stock ended the day up nearly 4%. The gain came amid rising hopes of local government help. Last week, a group of Evergrande's offshore creditors said they were ready to take all necessary actions to defend their rights if the company didn't show more urgency to resolve a default. Evergrande replied that it looked forward to communicating with these creditors to formulate a debt restructuring plan. But before that, the company said it would need to conduct further studies and evaluation. Evergrande's balance sheet currently shows over $300 billion in liabilities, including nearly $20 billion in international bonds. With that, we take a quick break, but still to come. Chase Bank and Instacart working together to launch a new credit card. What are the benefits and should you apply for one? We talk to an expert. And we take a look at the world's largest underwater museum, showcasing the ruins of an ancient Roman city that sunk in the 4th century. That and much more coming up on NTD Business.
Hello, I'm Mike Lindell, CEO of MyPillow. Cancel culture has not only affected myself and MyPillow, but also millions of you out there. My employees and I want to personally thank each and every one of you for all your support. At MyPillow, we have hundreds of products now, including my new slippers, bathrobes, sleepwear, and my new beds. We are offering the best products ever for the best prices ever. For example, we have the standard size MyPillows, regularly $69.98, now only $19.98 with your promo code. Or you can get custom fit with my premium queen size MyPillows, regularly $79.98, now just $29.98. Or my king size, regularly $89.98, now just $34.98. So go to mypillow.com now and use the promo code on your screen or call the 1-800 number below to receive these exclusive offers. Thank you and God bless.
Oh, hey, doesn't it feel like there's communists everywhere? In fact, the Chinese Communist Party has been subverting America from every angle. So whether it's compromising our politicians, controlling Hollywood, manipulating Wall Street, or infiltrating our schools, they have stopped at nothing to take down America. And I believe that in order for us to not become like China, we need citizens who know the truth. So go on over to getepic.com, stay informed with a subscription to the Epic Times, and you will get instant access to this infographic.
Shall we begin?
People are starving, sir. They're unable to buy a simple loaf of bread. Can you make any exception to the mark 666?
None. If you don't get the mark, you don't eat. It's that simple. My goal has never changed. People will bow down to me or they will die.
Welcome back. If you like having your groceries delivered, there's some good news for you. Chase Bank and Instacart are teaming up to launch a credit card that could save you money. The Instacart MasterCard will give you a chance to earn points on Instacart purchases, along with some other perks and benefits too. More details will be coming later this year, but we know it will be the first co-branded card offered by a food delivery service. There are costs associated with the convenience of grocery delivery. Instacart can charge you more for items you want delivered. Plus, there's the tip. But if you're looking to save time, this new card might be for you. Chase and Instacart say the card will be released later this year. So now we're delighted to be joined by Ted Rossman, credit card expert and senior industry analyst with Bankrate.com. Ted, pleasure. Thanks for coming on.
Thanks for having me.
Ted, I think we've all been in these situations where we arrive at a Macy's or a Wayfair or wherever it is, and we're offered a credit card, a branded one for XYZ benefits, right? This new one from Instacart, what are your thoughts?
It's definitely an interesting one to watch. The proof will be in the pudding. We don't know the details quite yet. Although I have a feeling that this could be an interesting card because Chase and Instacart have already been rolling out some benefits on existing Chase cards. Like, for example, up to 6 months of a free Instacart Express membership. I wonder if that might be a standard feature on this new card. Also, the popular Chase Sapphire Preferred card gives 3 points per dollar on online grocery purchases, including Instacart. I wonder if they might do 1 or 2 better on their branded card. Maybe they give something like 5% cash back. That would be in line with other popular retail cards. That right there would make a lot of sense for a loyal shopper.
What do you think in general when you get these offers? What do you look for? Fine print, or what should we keep our eye on?
Well, first of all, if you ever carry a balance, this is really true of any credit card, but especially for retail branded cards, the interest rates tend to be really high. I mean, on credit cards, interest rates are always high. The average is about 16%. But on store cards, it's common to see 20, 25, even 30%. So if you're among those half of cardholders who have credit card debt, focus on knocking that out before you go for rewards. Now, if you are somebody who's pursuing rewards, think about loyalty. If you're an Instacart shopper, for example, and you buy from them every week or every couple of weeks, well, then this could be a great option. But if you're somebody who only uses it once in a while and you kind of play the field and you tend to shop other places, well, then maybe a general purpose cashback card or travel card is better.
You think there are people who sign up for these cards, they don't realize the high interest rates? Are there people holding balances on these cards, Ted, do you think, Americans?
A lot, yeah, and it is a very profitable business. In fact, a few years ago, there was a Morgan Stanley study that found something like a third of Macy's total profit came from its credit card. I'm starting to see a change in the store credit card space because this whole buy now, pay later concept, like Affirm and Afterpay, Klarna, companies like that, they are starting to take market share, especially from retail branded cards. It's still big business. They are still peddled aggressively online and at the point of sale. In fact, most people who sign up do so impulsively. I think that's a mistake. I would suggest that you take a breath, take a pause. Yeah, sign up if you can pay in full and avoid interest and get good rewards, and if you shop there a lot and it makes sense, but don't fall into it just, because somebody was offering it in exchange for a one-time discount. You want to make sure that you're a habitual shopper who's going to get something out of it.
Absolutely. Ted Rossman, really appreciate it. Thank you so much.
Thank you.
And from paying off your credit card debt to buying your first Rolls-Royce. The average age of Rolls-Royce customers may be younger than you think, according to new data. The luxury automaker reported the average age of buyers in the U.S. and globally is 43 years old. That means many of its customers are much younger, possibly in their 20s or 30s. The car maker recently announced it broke records with its 2021 sales. About 5,600 of its vehicles sold worldwide last year. According to the consulting firm IHS Markit, the automaker had a higher percentage of buyers under the age of 45 than many of the other luxury and exotic brands during last year's third quarter. With tax season starting today, January 24th is the first date the IRS will accept and process tax returns. This year, parents are advised to keep a special eye out for an IRS mailing letter known as Letter 6419. The letter pertains to 2021's Advanced Child Tax Credit, which was paid out from July through December. Families received up to $300 for each kid age 5 and under, and $250 for children between 6 and 17. Letter 6419 will help parents accurately report the amount of money they received up front in 2021. If parents did not receive one or more child tax credit payments, they're encouraged to call the IRS. And in the Mediterranean Sea, just a few miles from the Italian city of Naples, is an ancient Roman city submerged under the waves. It's now the world's largest underwater museum, and tourists visit the site year-round. Let's take a look.
In the days of the Roman Empire, the town of Buyout was a playground for senators, wealthy Roman citizens, and emperors. Julius Caesar, Cicero, Hadrian, Augustus, Mark Antony, and countless others all visited Buyout. where they kept villas and palaces.
Buyout was a place where people had fun, ancient Roman style. We're talking thermal tourism and also ego-gastronomic tourism, as we call it, because there were products of excellence from this area, both at sea and on land. The great wines of Campania or the farming of mollusks, oysters, fish from Lake Reno.
But towards the end of the Roman Empire in the late 4th century, the land began to sink below sea level due to volcanic activity. Changes beneath the Earth's surface led to a periodic lowering or raising of the ground level.
The drawback, mentioned in ancient sources, was that Buyout was often referred to as a place of ruin where people came for excellent and noble reasons, such as thermal therapies, but then they carried out practices much less related to those activities and more related to personal enjoyment.
The ruins of Buyout were discovered by chance in 1969. Further excavations took place in the 1980s, but no excavations have been carried out since then, and a large portion of the ancient city still remains undiscovered.
400 meters of remains stretch from the current coastline. Therefore, many settlements, many houses, many baths are still to be discovered and are only minimally known. Columns, new floors, new mosaics are constantly emerging during the research that the park is conducting, and in particular, next spring, we will begin excavating one of these places.
The underwater park has become one of the main attractions of the archaeological park in the region. About 15,000 people come to visit every year through snorkeling, diving, or aboard boats.
That's the latest business updates for today. You can still catch NTD Evening News with Stephanie at Cox. That's at 6:30 p.m. Eastern. For NTD Business, it's all for today. Thank you for watching. We'll see you tomorrow.
Thanks for watching us on YouTube. Did you know YouTube only keeps selective videos on its platform? So if you want to make sure you get the full picture, just subscribe to our newsletter. Go to newsletter.ntd.com and sign up. It's free.